Hey, welcome back, everybody, to today's Market Explained. This is the show where we talk about the economy and the markets and give everybody an update on what's going on in the world. I'm Brian Castle. I'm your host, and I have with me my traditional co-host, Mr. Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Good afternoon, everyone, and glad to be here and glad to talk a little bit about the markets.
Well, excellent. We are coming to you a couple weeks before the election. It's the 24th of September. So now we've got a lot to discuss about this. Since the last time we met, what's going on with the markets? Let's get an update there.
Yeah, so we still have domestic equities leading in the number one position, and it's actually unchanged since the last podcast. So it's still holding at 324 tally points. International equities has remained relatively steady as well in that number two position at 240. It did lose one tally point, but it's remained relatively steady. Commodities is kind of the big loser, if you will, since the last podcast. It lost 17 points in that third position. It's at 212 tally points now. So still, I would say comfortably in that third position. But for a while there, if you guys remember, it was almost tied and kind of jostling back and forth with international equities for that number two position. So that has separated quite a bit since. Cash is in the number four position. It's at 134, and it was the big winner. It gained 11 points from the last podcast. Currencies is in the fifth position at 94 tally points, gained 1 point. And fixed income still in last. It's at 85 tally points, and it gained three from the last podcast. So I think the biggest moves, obviously, from the downward side was commodities, and on the flip side, the upward side was cash was the biggest gainer.
Yeah. And, Chris, we don't usually see cash go upward in a bull market. So we're at new highs after the Fed raised rates or lowered rates and everything. But it looks like almost all of the gain in cash came from commodities, right? So commodities faded versus everything.
Yeah. I mean, I think domestic equities right now it's not the highest it's ever been, but I think with the uncertainty that we kind of see, I mean, yeah, we are in a bull market, but it doesn't really feel like a bull market that we've had in the past, like a 2017 or even 2019, where we've seen these really big bull runs. It's kind of like a bull market, but everyone's waiting for the other shoe to fall, kind of, or that unknown corner to turn. So, I think we've seen that domestic equities really tap out, and international equities, for the most part, has been relatively stable. We've seen some weakening around the world. So commodities have really been the relative to the other asset classes the weakest. And I think currencies and fixed income still have a little bit to go before I think they start to kind of base and move off, or they base but really start to gain significantly. So I think cash was really the only, as you were saying, Brian, the only one that was left to really take the points.
That's right. And like you said, domestic equities are near a high, although we did check back into the 2000s, and there were periods of time when domestic equities had a higher score than 324, but not a lot higher than here. So we're pretty much near new highs as far as like domestic equities versus everything else. And international has clearly taken leadership in the second position from commodities. That for a while last year they were neck and neck. One would be above second position, then they trade places back and forth a few times. So there's no real direction. So clearly, domestic equities is the leader. International equity stocks is the second position, and that really hasn't. We haven't seen that seriously in a long time. International equities. So that's kind of curious situation.
Yeah, no, it's going to be really interesting to see. I mean, there's been times, I think, even going back to like 2016, 2017, coming in 2018, where there was this expectation that international equities was going to kind of take the steering wheel, if you will. And it's really never happened. One thing or the other, China's had issues, and there's always been some kind of drag that's always held it back. We'll see. I mean, I think right now it's more of a prime candidate with the dollar weakening now a little bit. If we potentially see that, the international takeover. But I think right now, what we see currently is domestic equities, I think, is still kind of holding strong, as far as asset classes go and even just strength of the overall economy.
Yeah. Well, and unless we see another really big spike in interest rates like we did in 2022 and into 2023, fixed income may have seen the low. The low was about 65 tally points. Now we're up in the 80s. But that all happened where fixed income collapsed because interest rates had to rise quickly and people couldn't react terribly well. So fixed income was the worst investment for the last basically 3 years. And but it's acting a little better now that the Fed lowered rates. So we'll see if that's more stabilized. The last time we had such a terrible fixed income market was in the late 70s and the early 1980s when we had high inflation. They had to raise interest rates dramatically, and we saw the fixed income investments really did poorly. But then when rates rose, I remember as a young investment advisor in the early 1980s, we were buying tax-free bonds at 12 and 14%. It was completely different environment, and that was a great time to buy bonds because you got good yields. And then when rates went down, the bond prices went up. So that was the best bond market ever after one of the worst bond markets ever. So maybe, Chris, if it works out that way, and the Fed is right about their rate move, maybe this will be now one of the best bond markets as well. Just like no one actually predicted it would be that way in the 80s, but it ended up being that way. So maybe there's a chance we have a really good bond market from here on out.
Yeah, yeah. I mean, I think if the Fed completes what they want to, which is a soft landing there, we don't see them have to raise interest rates again or see any volatile in that front. I mean, I think over the next couple of years, especially, we could see a little bit of a run in the bond market.
Right. So now, Chris, the Fed did cut rates. So let's dig into that.
Yeah, so the Federal Reserve cut kind of a surprise move and a surprise move. There was this debate whether they were going to cut a quarter of a percent or 25 basis points or a half a percent or 50 bips. And I think most people, the expectation was 25 or a quarter. But, last minute rumblings and everything kind of started pricing in this half a percent move. And that's ultimately what they ended up doing. So they brought interest rates down a half a percent. So now it's between a range of 4.75 and 5. That's a pretty big move. And I think, the reaction to it, I think, was a little more tepid than what people initially expected. I think, people think, all right, they're bringing the interest rate down. They're kind of letting the reins off a little bit, and they expected the economy or the market really to take that as an explosion upwards. Really didn't see that. I mean, we definitely saw a little bit of movement upward, and it was a broad movement. We didn't see tech stocks or any of these really explode upwards, and I think some of that is the thought process and trepidation on the market is the Fed behind the ball? There's concern of that. Like, why was there a 50 basis point cut? Because most of the economic indicators and economic numbers, really outside of the job market, which was showing some slowing, was for the most part positive. So what warranted this 50 basis point cut? And I think a lot of people came up with, all right, well, are they behind the ball? What's going on here? Because as much as we want lower rates, that obviously provides more liquidity. As a consumer, you want lower rates. The concern is you're using, you think about, as like a weapon or something like that. This is their defense, and every cut is ammunition for them. And if they're spending a big chunk of that ammunition in this first cut, that's less they can use if there's an issue down the line. So I don't know. It's really an interesting move there. I've seen both sides. Some people praised it, some people haven't, but definitely I think took the market a little bit by surprise. As I said, they were starting to price it in a little bit, but kind of an interesting move there.
Opinions are widely varied on this too, Chris. Everyone expected 25 basis points. They moved 50 basis points, and they really kind of popped the market in a sense, right? And they energized the cash markets. We're still running $2 trillion deficits every year. That's become the norm now since the pandemic, which that's got to stop, or we're already at an existential level of national debt. That's got to stop. But with all that extra spending out there, and then the Fed liquefying the banks by cutting the federal funds rate so much, there's worried concern. We've talked about this many times on this show that they're going to reignite inflation. And so that's a worry. The Fed thinks that inflation will come down to the low twos, their target, either way, whether they cut rates or not, because of some structural reasons in the economy. And we saw 818,000 jobs that were announced actually were taken out of the job rolls, where they did a 30% adjustment. So some of those things the Fed thinks are leading to the fact that the economy is slowing down. We're not going to see an igniting of inflation. But if we do, it'll be a real mess if we do. So the chance is slim, but I think it's still possible. That's what happened in the 1970s. But that's not the case here. But
Yeah.
Chris, they exploded the market broad-based, didn't it?
So yeah, I mean, I think it's one thing I'll mention, I think that's important with that inflation too, real quick
Oh
before,
yeah.
is I think that the other important thing to note, Brian, is the fact that it's out of our control. I mean, everyone can sense, I think, the heightened tension, geopolitical tensions, what's going on in the Middle East. And all it would take is one errant rocket or one errant, something to detonate, and all of a sudden you seeing supply lines crippled. We've already seen this a little bit with the attacks on the shipping lanes, the Red Sea. So I mean, I think the aggressive hike there, even if inflation's looking better, with all the potential causes that could come that could rear inflation again, I just think that it was a little too aggressive and wasn't needed. But I guess only time will tell.
Yes.
So, as far as a couple other numbers, as far as the U.S. economy, we got some interesting news actually this morning. U.S. consumer confidence came in, and it actually dropped to 98.7 in September, and that's the largest decline since August of 2021. Which so that was kind of just before we were going into obviously 2022, which was a bit of a bearish year. But bad year for the markets. And that was also well below the expectations, which was actually an increase in confidence to 104. So, really interesting. We're starting to see the US consumer kind of sour a little bit. So we'll see if that has any impact. And maybe this was what maybe the Fed had some data that we didn't have, or they were looking at the data in a certain way and thought they were behind the ball. Who knows? But that's certainly concerning a little bit. Sales of previously owned homes fell 2.5% in August from July. So, that's interesting. We've talked a lot about it. Usually, as interest rates fall, you would expect to see sales of previously owned home, or just general home sales to rise, because we have this entrenched, I don't say faction, but this entrenched population that owns a home now at interest rates that are just locked in at 2.5% or 2%, even 4%. It's better than the average rate now, which is about 6% for a 30-year mortgage. So we still haven't seen that happen yet. And in some cases, we may see this actually slow further, even though interest rates are coming down. Now there's the anticipation that they're going to come down. So no one wants to lock in at a 6% interest rate if they think in a year they can get a 5% interest rate, right? So now comes the waiting game of, all right, well, if I wait a year, and then this is just, I think coincidentally, this is also why deflation is really bad, right? Because deflation is terrible because spending just drops off a cliff, because if goods are getting cheaper, why buy something now? And if a year it's going to be cheaper. It's the same kind of theory right now with the interest rate. So we could see actually home sales fall, just as people are less incentivized to move because they feel, hey, if I wait a year or 2 years, I'm going to get a better rate. And I'd rather move then, instead of going through this process and having to refinance and things like that. So, on top of that, the national median existing home price came in at 416,700. That was a 3.1% increase year over year. So we continue to see, even though that was down a little bit from the previous month, year over year, we continue to see home prices rise. And this is another, I think, tough factor for the economy. And this has been, I think, widely publicized, but, usually during this crunch, this kind of where we have higher interest rates, you want that period to be a consolidation for the home prices. You want those to drop, and we never saw that. And so, what we're having now is we're going to free up some liquidity in the market, and you're going to see housing prices continue to most likely rise just as you get more people in the market. Now more people can afford housing because, at a 6 or 4 or 5% interest rate, they can afford those mortgage prices at these elevated levels. So it's going to be really hard, I think, right now, and people that purchased it. So you're going to get these two kind of pre and post rate hike cycles. So it'll be interesting to see from there.
Yeah.
Uh, and then the last little bit I'll talk about is the inflation adjusted median household income came in for 2023. It was actually at $80,610, which is up from the original estimate, up 4% of 77,540. But even more importantly, this actually took us back to the kind of median household income, which is inflation adjusted. That's important to note. Where we were at right before the pandemic, about 2019, it was about 81,000, I want to say. So we kind of, with all this inflation and everything rippling through, we saw this big hole kind of divot, the impact on the actual inflation adjusted household income. We're finally kind of digging back up and out of that, almost 5 years later coming up on. So that's, I guess, good. And one end, that's good. But hopefully we see policies and everything put in place that are going to continue that growth and prosperity wise, because that's what we need. I mean, inflation's, even though it's coming down, as we've talked about, goods, unless we get a deflationary cycle, goods don't necessarily deflate. They just increase at lower increments.
Exactly. Very
Uh,
good. Well, Chris, turning to the international front, there were some other things going on about China as well, right? You had some.
Yeah, and this is pretty big news. It's driving the markets a little bit this week so far. The PBC, or People's Bank of China, came out and they cut their 14-day interest rate by 10 basis points to 1.85%. And on top of that, they're injecting about 74.5 billion yuan, which is about 10.6 billion US dollars of liquidity into the Chinese economy. So this is the most aggressive stimulus we've seen since the pandemic. So we talked, China's definitely struggled. Their economy is struggling. They're struggling with deflationary pressures. And this is another attempt by them to really kind of try to jumpstart their economy. It has a big impact on the global markets because they're a big consumer of commodities. So we're already seeing that impacted right now. Hopes that this works, that with the stimulus, that we're seeing oil prices up 2%. But then they're a big consumer of raw materials. So we'll see. Their attempts have for the most part failed. It's been kind of like, shooting a bullet at a freight train. It just really hasn't done much. But we'll see if this is obviously a large stimulus package, if this helps at all. On top of that, staying in the Asia Pacific, Japan's consumer inflation number came in and it grew by 3% in August year over year, which was above kind of what the Bank of Japan would like, which is about 2% target. So we are starting to see inflation creep up a little bit there. We've talked a lot, I would say, about the reverse carry trade, the impact, inflation in Japan, because it's an island, they're highly dependent on imports. So that yen, the Japanese yen, the strength of it plays heavily into inflation there. It's been weak, obviously, with the Fed lowering interest rates. That helps a lot, helps the Japanese yen, and has kind of alleviated some of that pressure. But I think what the market's looking at right now is, if inflation continues to maintain an elevated position there, could Japan have another surprise rate hike or rate hike? And I know Japan's tried to kind of put that out there, that they're not going to surprise anyone, but there has been some mentioning as far as October, November, having another rate hike in Japan, which would be really interesting. And obviously, we saw the volatility spike that caused with the whole reverse carry trade. Even though they are raising rates, they're still insanely low compared to, I mean, we're talking near zero, relative to the US interest rates in US, which is, 4.75 to 5. There's a big differential there. So there still is a lot of people, doing the reverse carry trade. So there still is, I think, a margin there for volatility if we see any movement there.
Yeah, well, good. Well, interesting. And then also a sad story, Chris. Well, this is more into the what we see out there. Let me cover a couple other issues. The international longshoremen have threatened a strike that would really disrupt the entire world. We haven't had one of these strikes since the 1970s. And Chris, if they do this, it would start October 1st, and it's the longshoremen on both coasts versus the U.S. Maritime Alliance, which is the representing the management. And realistically, I mean, anything that's created in America obviously is here, but anything that has to come to America mostly comes by boat, not by plane, because they just so much more capacity in these massive boats, right? So 1 day strike, they estimate, would affect the economy for an entire week. It would take a whole week to clean up the mess from 1 day. They've even started to slow down on shipments that are coming over from Europe because the shipments take a couple of weeks and they have them all in sequence, right? And a full week of strike would disrupt the economy well into 2025. So it's really damaging if they had a strike from the longshoremen. So we'll see what normally the president step in. And we'll see what the Biden-Harris team will do because they're still in charge of the country, obviously. But Biden has already said that he won't get involved. Now, there's some speculation he doesn't want to help, Kamala Harris because there's been a lot of people who wanted Joe Biden out, and he wasn't leaving the campaign. He finally got pushed out, and he was ousted. So they think he doesn't want to help Harris, even though they're claiming to be allies still. Then there's also speculation that Biden is trying to win back the union vote by letting the unions go massively and disrupt everything and disrupt the economy in the short run to win votes in the unions because they've been losing out the unions. In fact, the Teamster union just voted majority of the Teamster members wanted President Trump. So there's a lot of politics involved in some of this economics now as well. So we'll see what Biden does. They haven't signaled what they're going to do right now. He's still saying he won't get involved, but I think the pressure will mount over the next couple of days, and they've got to probably do something. So anyway, we'll see what happens there. Chris, the Fed did decide to make their big change, right? They changed their whole policy and they cut rates. And so now we're worried about the potential inflation coming back. We talked about it. The stubborn inflation had been as high as 3%. Recently, it's down just a little bit below 3%, but it's got to go to 2% to really get back in line with the norm about, what the inflation normally should be.
Yep. Yeah. I mean, I think an important thing to note real quick, I'll just add on with the longshoremen that you mentioned is that, I mean, the impact that could have on inflation, if we see that extend out for a period of time, if there's no intervention, we saw it, car prices. I mean, that was a big one. If you're not getting cars imported in, you're talking about a decrease in supply, same amount of demand, you're going to see an increase in prices. So, that's another, I would say, kind of another potential scenario from left field that could kind of throw the Fed's plans off base.
Yeah, absolutely. So and then since we're still in silly season, campaign season, there's a lot of proposals being talked about, but some of the proposals from the Harris campaign got major pushback for price controls, for example. Price controls have never worked. They actually tried them in Europe, in the UK for 3 months, and they stopped. Price controls are what had taken, and we mentioned this on a previous show, the number one economy in South America. The dominant economy in South America was Venezuela, as recent as 50 years ago. And then price controls from the Hugo Chavez regime basically destroyed the economy. Now it's a complete basket case with people leaving the country and runaway inflation because they have total power and total control over the economy. They won't let capitalism reign and the free market reign. So they've stopped talking about price controls. They are coming up with some proposals like $25,000 for a home, but everyone, for a first-time home buyer, but everybody knows that would take home prices higher. We have a huge problem. We don't have enough homes in America. We have 6 million homes that need to be built, 6 million dwellings, shortage, and prices don't seem to want to go down We did have the all-time single-family home price reached about a month ago, but now it's down a little bit from that, Chris, right?
Yeah, now it moved down to it was at 416,000 lower.
Right, exactly. But yet we're still near new highs. So with all the not in my backyard effort from politicians, don't want to build here, don't want to build there, they boxed us into a corner where there's really not nowhere to build, and they've got to start letting areas be built, and they've got to let the home builders do well. Now, the ironically is home building stocks are doing very, very well right now, Chris, as you pointed out in this rally, and we have a broad-based stock market rally. And home building is seen as very profitable and very, very necessary right now. So the market likes it, doesn't it?
Yeah, no, I mean, I think that's definitely been one of the big drivers. I think obviously, the knock or the struggle, if you will, that home builders have had, because we have had this imbalance in supply and demand for homes, has been that, to build a home, the price has still been, especially at these higher interest rates, at a point that most Americans couldn't afford them. So, it hasn't necessarily been oversupplying, especially in certain states. Some have fared better than others. Home building is, you have a lot of codes. There's a lot of tape. So depending on the states, there's a lot that could impact that price. But I think the hopefulness is now that interest rates come down, a lot of those homes become more affordable for a greater swath of the general public, and that helps ease up hopefully some of our housing prices. Problems. The other impact too is that comes down to the cost of doing business is a little cheaper, so they might be able to sell those homes for a little bit cheaper as well.
Exactly. All right. So what else do we have in what we see out there, Chris?
So a couple interesting things I'll note. The iconic kitchenware maker Tupperware has filed for bankruptcy, Chapter 11 bankruptcy. So there is still a potential where we could see the name. It could be purchased by another competitor, things like that. But kind of a sad instance there where you had a product that really took over. I mean, we still call what isn't actually Tupperware, right? It's one of those like a Xerox, right? It's still kind of that idea. And they just lost the ball, got outcompeted in their space, couldn't control the price as much, and just really got outcompeted. I did see a statistic that like 500,000 people on Amazon search for Tupperware, but they get directed to other products, competitors. I mean, there's a million different varieties nowadays. So interesting note there, and kind of a sad end to such an iconic brand. Boeing, their factory workers went on strike this past week, which is really interesting. Obviously, Boeing's been struggling with just I would say incident after incident, and it continues to put the company in a cash crunch. I know they're taking a lot of the executive staff are deferring compensation, things like that, to try to hopefully save some money and conserve cash. But it continues to put Boeing in a tough place right now. So it'll be interesting to see. They have still not reached an agreement as of right now. So that'll be interesting. And then on the flip side, Microsoft continues to do very strong, and they're actually increasing their dividend by 11%. They announced, and they're also doing a stock buyback program with purchasing up to 60 billion. That's billion with a B, dollars worth of stock. So you continue to see certain stocks really feast, whereas Boeing and some other ones just are struggling. They can't get out of their own way.
Yes. And Microsoft is doing very well with the AI and the Chat GPT. So that's kind of revived their fortunes a little bit. Not that they were ever really terrible, but it's just given them a new boost. So that's exciting stuff. Chris, there's a lot of crazy culture things going on out there, and a lot of this stuff affects the economy and the markets. In Philadelphia, we have some good friends in Philadelphia. They've corroborated this story. There's been 5 different groups that met for big, over the road car races where they'll have cars race down a road late at night, and real loud and causes a lot of disruption. And so some police cars have been damaged. They had these road rallies essentially. And anyway, the police claim they found everyone on tape, but when a society goes through that, where these crazy car races are going on, everybody gets scared. People don't come out. They've actually seen same store sales numbers at retailers in Philadelphia weaker during this period of time because people aren't going out. They're scared because of all these crazy car races. Anyway, police claim they found everyone on tape. They're going to chase down the participants or knock on the door. So if you get a knock on the door, it's the cops. So if you were involved in a car race down there, we'll see what happens to you. Israel, obviously is still dealing with this whole situation that happened October 7th of last year, and Hamas, and they, pretty much rid the Gaza Strip of these Hamas folks. So there's still more there. Now they're threatening to go into Lebanon because the Hezbollah is shooting rockets at them as well. They've now put out a message to the folks in Lebanon. If you're being used as a shield, as you're a citizen, to leave the area, don't stay. If your garage has rockets in it and you know about it, you better get out of your home because we're going to go after your garage. And so they're talking about all that. Of course, that kills commerce. Whenever there's wars, it kills commerce and all activity. But that's the latest thing that's going on in the Middle East. The fact that a lot of these things are going on, there's a sense because of the change in leadership and clearly that President Biden has been shown to not really be up for the job. And he's just kind of wasting out the last couple of months of his term during this election season. There's some concern about what others will do. Now, China has been threatening to go into Taiwan forever. So there's a sense that might happen soon. Recently, President Biden forgot he was supposed to introduce the Prime Minister of India. So an aide had to jump in and introduce the Prime Minister of India. So just all those little things are give it a sense that America is not really on its best days right now. Vice President Harris is not stepping up because she's running for president, trying to distance herself from the current president because he obviously isn't doing well. She's only done 8 press conferences, and only one of them was actually spontaneous. The others were already pre-planned. Then the other opposition, Trump and Vance, have done over 75 press conferences. So, he's not doing any more debates. President Trump, after that debate that was very biased, he's not doing any more debates. So we're just going to have to wait this out for the next 5 weeks or 6 weeks and see what the voters finally say in the election. And then we'll get some direction back to our country. We'll know who will be the leader, whether it be Kamala Harris or President Trump. So we'll see. But this next month could show lots of risky things happening in the world. And hopefully China doesn't do anything with Taiwan. But we've had wars started during this administration, and we hope there's not more. So anyway, I think that's all we see out there right now, Chris, unless you have anything more.
No, I think that about covers it.
Okay. Just an update on one post. We did a post on America's obsession with food and our obesity crisis. Well, I'm sitting today in Budapest, Hungary, and one of the things I've noticed, and I've noticed this in other European countries and other societies around the world, that we do have habits in America that cause us to overeat. Every big cup is a big gulp. You go to 7-Eleven or you go to McDonald's or you go to Starbucks, and the drink is a cup that's 12 inches high with an extra long straw. Well, I noticed a lot of those things here in Hungary are not that way. Like the massive big gulps, they don't have those. The largest cup you can get is about 6 inches high at Starbucks, and not the 12-inch high cup. The buffets are still plentiful, but they're smaller plates. The omelets are 3 and 4 egg omelets in America. They're only 2 egg omelets here, and many of the juices at a buffet are already poured for you. Like they don't let you pour your own massive cup. So the rate of obesity, and we can tell just by seeing people out in public here, is much lower in Europe as well. We know that the rate of obesity in America is 42%. Japan, it's 4%. I know it's more than Japan here in Europe, but not certainly as much as America. So very different way of thinking. And so we do need some change in our food situations in America, and hopefully solve this obesity problem. Just wanted to give an update on that because we put out a whole blog post about that and a bunch of different podcasts with interviews about that whole subject. So that's available on the Leadership Matrix and the 4starwealth.com site. Also, stay tuned for some podcast interviews that we're going to be putting out We're going to talk about tax mitigation strategies. You can get big tax deductions by investing in historic properties, in charitable businesses. You can get IDC deductions from investing in oil and oil drilling. There's also fee simple real estate transactions where you get a 5-to-1 write-off. There were conservation easements that have gone away, but there are still opportunity zones people have heard of, and then also investing now in solar systems. So we're going to talk a little bit about all that. Why would we do this is, Chris, there's folks that can do Roth conversions and they would take a big gain. Well, is there a way to shelter that gain? So a lot of folks are doing Roth conversions using these tax programs, large gains from stocks, selling businesses, or if you're getting paid out of the personal holding as part of a prearranged sale of a company you sold, you have big gains and they happen in 1 year. And so that's why we're looking at some of these tax programs. So stay tuned. We're going to do a whole episode on that later on. All right. And I think that's right, Chris. I think we'll leave it there. I think we're done.
Yeah, sounds good.
Okay. Well, great. Well, thanks, everybody. Thanks, Chris. Thanks, everybody, for being with us. This ends another episode of the 4-Star Today's Market Explained. We'll be back again in a couple of weeks with another great episode. Until then, over and out. Bye-bye, everybody.